Okay, let's unpack this. Welcome to the deep dive, where we take a stack of information and really distill it into what you need to know.
Exactly.
Today, we are focused entirely on Acacia Research Corp, that's ACTG, and their Q3 2025 earnings call. These results, they hit the wire pre-market on November 5th.
And this is really a deep dive into an identity crisis, but, the good kind. ACTG is aggressively trying to transition away from its old, lumpy IP licensing model.
Right.
And they're aiming to become this disciplined, cash-rich industrial operating company, all built through acquisitions. So the mission today is to see if the execution, from CEO MJ McNulty and CFO Michael Zambito finally validates that big pivot.
And based on that initial market reaction, that validation was loud. This wasn't just a beat. It was a huge outperformance. It really signaled that their strategy is starting to work.
It really is.
So let's start right there. We call this segment the big beat.
I mean, when you just look at the top line, the sheer size of the beat is kind of stunning. Total revenue came in at $59.4 million.
And the estimate was what?
For context, the consensus estimate was sitting around $38.0 million.
Hold on. So they didn't just meet expectations. They blew past the street by over 56%.
Yeah.
That's not marginal. That is a huge surprise. And it's a 155% increase year over year, which, that has to be from integrating these new businesses.
Precisely. And what's really validating is how that revenue translated down to the bottom line, and I think most importantly to cash flow. The street was braced for a non-GAAP adjusted EPS loss of about negative 14 cents a share.
A pretty hefty loss, yeah. So what did they actually report?
They reported an adjusted loss of only negative 1 cent per share.
Wow.
They basically eliminated the entire expected loss. I mean, narrowing that gap by roughly 93%. It tells you the new segments aren't just bringing in sales, they're bringing in a margin structure that's way healthier than anyone thought.
That's the key distinction, right? Volume without margin is just, busy work. But you couple that with cash generation, and now you have a proof of concept. The indicator I zeroed in on was free cash flow, which landed at a very, very solid $7.7 million for the quarter.
And that SCF number, that's the gold standard. Total company adjusted EBITDA was $8.0 million, and the free cash flow tracked right alongside it. The detail management gave that really impressed me was that all the operating segments, energy, manufacturing, industrial, all of them, contributed positively to that cash flow.
So the platform is self-sustaining. It's not just one winner carrying the whole company.
Exactly. It means the M&A machine is generating its own liquidity.
That's a great point. Let's transition now into the why behind that. We're moving into our deep dive, the industrial pivot and financial engineering. The shift in their portfolio really defines this whole story.
It absolutely does. The inorganic growth strategy has just completely rewritten ACTG's revenue mix. The manufacturing segment is now the single largest piece of the pie. And this is mostly Deflecto, the business they bought back in October of 2024.
And that segment alone
pulled in $30.8 million in revenue this quarter.
So wait, we're talking about an acquisition that was finalized just a few quarters ago, and it's already the engine room for the whole company. If you add it all up, manufacturing and energy together now make up, about 76% of total revenue?
That's right. The legacy IP model is, for all intents and purposes, a residual asset now.
Okay, so if you're an acquisition company, your most important asset is your war chest. And this is where the financial side gets really compelling.
It does. Acacia holds $332.4 million in liquid assets. We're talking cash, securities, loans, receivable, the whole thing.
Let's just pause on that number, because this is kind of the core of the whole thesis here. If you divide that liquid asset base by the share count, you get roughly $3.45 per share, just in cash and liquids.
Now, compare that $3.45 per share to the company's current stock price.
They're almost the same. The liquid asset value is neck and neck with the entire market cap of the company.
Which means the market right now is doing something incredible. It is assigning a value of 0 or maybe even a negative value to the actual operating businesses.
Well, businesses that just generated $7.7 million in free cash flow this quarter.
Exactly. Benchmark, Deflecto, Printronix, you're getting them for free.
So why? Why is the market maintaining that kind of staggering discount even after a quarter like this?
Well, historically, ACTG was a value trap because of that unpredictable IP licensing. So the market has this ingrained skepticism.
Right. Show me, don't tell me.
It's a total show me situation.
Yeah.
Until they see, multiple quarters of sustained industrial margins, the market's just going to discount those businesses, assuming there's some kind of operational rot or that the cash is just going to get burned on a bad acquisition.
That makes sense. They have to overcome a decade of perception. But it looks like management is showing discipline in other ways, specifically with debt.
Absolutely. Their total consolidated debt is non-recourse, sitting around $94 million.
Yeah.
But they're actively paying it down. Since they bought them, Benchmark has paid down $24 million of its debt, and Deflecto has paid down $13 million.
So they're deleveraging. That says a lot about their priorities.
It really does. It's smart capital allocation.
Okay, beyond the balance sheet, let's talk about the operational elbow grease. You mentioned they're trying to mitigate macro pressures. What did they actually do? Because cost savings can sound like, boilerplate.
No, they got specific. They're restructuring Deflecto. They broke the company into 3 distinct business units.
For what purpose?
Clarity and agility. You're separating areas like the highly regulated fleet products, things like mud flaps from, say, consumer office supplies or the retail channels.
So if the Class 8 truck market is soft, which it is, they don't want those cyclical problems dragging down the whole manufacturing segment. They're building firewalls.
Exactly.
Yeah.
This lets them use targeted pricing and have focused management teams for specific headwinds, like, the trade uncertainties, hitting office supplies, without having to overhaul the whole operation. It's a smart, strategic unbundling.
Okay, let's move on to investor context. Growth engines and headwinds. Now, speaking of those headwinds, management didn't give formal guidance, but they did set a very specific target for Deflecto.
Right. The key target for Deflecto is to hit low to mid-teens adjusted EBITDA margins over time. That is the hurdle. That's what they need to prove that the acquisition wasn't just strategic, but that it was operationally successful.
Okay, let's look at the segments one by one, starting with energy. So, Benchmark. They delivered stable results even with softer oil prices. How?
That stability comes from some really intelligent financial planning. Benchmark has hedged over 70% of its operated oil and gas production all the way out through early 2028.
So they locked in their prices.
They did. They sacrificed some potential upside if prices spike, sure. But in return, they've basically insulated the vast majority of their cash flow from commodity swings for the next few years.
And that insulation is exactly what this kind of company needs right now. Predictable cash flow to fund the M&A, not, wild commodity bets. But what about growth in that segment?
The growth engine there is this undeveloped Cherokee acreage position. They haven't drilled a single well on it yet.
So they're just sitting on it.
Not just sitting, they're strategically optimizing it. Small acquisitions, land swaps to create the perfect land package. They're positioning themselves for a future sale or maybe bringing in a partner for a drilling program. It's a valuable lever they can pull when the time is right, but right now they're preserving capital.
Okay, now back to the manufacturing headwinds at Deflecto. The Class 8 truck market is weak. I saw it had its weakest September order since 2019.
It's true, it's a tough environment, but their counter-cyclical defense is actually pretty strong. A big chunk of Deflecto's products are essential and regulation-driven. Think safety equipment, like those highway triangles and mud flaps.
Non-discretionary purchases.
Fleets have to buy them.
They have to. So when the cycle eventually turns up, that essential demand base will position them to accelerate really quickly.
And meanwhile, what about the smallest piece? Printronix.
Printronix has been the quiet success story. It's just delivering consistent, strong performance. Crucially, they have a great balance between hardware sales and the much higher margin consumables, like printer ribbons and supplies. So the turnaround there is complete, and it's just a steady source of sticky, high-margin cash.
And we can't forget the IP segment, even though it's not the focus anymore, it's lumpy, but Q3 was a definite win. It was. The IP segment brought in $7.8 million in revenue, and almost all of that $7.4 million was from paid-up licensing. Management confirmed this includes the Bantiva settlement. So the original business is still a potent, if unpredictable, lever that can just drop millions onto the balance sheet.
That's a great setup for this last point on management communication. During the Q&A, someone asked about investor visibility, which has been, famously low.
Yes, and the CEO, McNulty, he gave a fantastic answer. He confirmed the lack of IR was deliberate. He said they didn't want to look like carnival barkers.
I love that quote.
Yeah, they felt they needed to execute first before trying to sell the story.
That's that show me culture in action. And now that they have a couple quarters of execution under their belt, they're shifting gears. proactively engaging investors, presenting at conferences, going after sell-side coverage.
It's a huge signal. It's telling the market, we've built the foundation, we've proved the stability, and now we are ready to scale. They're actively trying to chip away at that skepticism we talked about.
Okay, here's where it gets really interesting and where we connect this back to you, the listener. We are now at our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea based on what we just heard.
The trade rationale, it all starts with that staggering valuation gap. The market cap for ACTG is sitting around the mid $300 million range. And we just established their liquid asset position is $332.4 million.
So if you bought the entire company, you're essentially getting the operations, the free cash flow generating businesses, plus the IP pipeline for a value that is functionally zero, or you could argue maybe even negative.
The pitch here is to go long ACTG as a cash-backed compounder. And this trade is not a bet on immediate improvement in industrial margins next quarter. This is a highly subsidized, low-risk bet on management's ability to execute one more large, value-accretive acquisition.
You're betting on the discipline they showed with debt reduction and the scale they proved with Deflecto, but you're applying it to that $330 million plus cash pile. And the timing here seems critical.
It is. Management explicitly said they're seeing more private equity businesses for sale because they're struggling with high debt. The rise in interest rates has just squeezed these highly leveraged private assets, pushing multiples down.
In other words, the cash pile is M&A dry powder that's being subsidized by the public market's own skepticism. You're buying the cash at par and getting a free call option on management successfully buying a distressed asset at a cheap multiple.
Exactly. The trade is a multi-year play for a re-rating. The goal is to move the stock from its current deep value multiple, where it trades like a pile of cash, towards a small cap compounder multiple, where the valuation reflects the growth and stability of the earnings. The cash bridges the gap. The operations create the new multiple.
So wrapping up Q3 2025, what does this all mean? The core takeaway is, I think, very clear. ACTG has demonstrated solid execution. We're talking inorganic growth, margin improvement, robust free cash flow, all solidifying that pivot away from being a pure IP vehicle. They are delivering?
And while the stock did rally after the results, the modest gains since then confirm that the market still needs to see more. It requires continued, consistent execution, especially hitting those margin targets at Deflecto, before it's going to fully shake off that deep discount.
Okay, so here is a final provocative thought for you to chew on. Management noted that the U.S. legal environment seems to be more IP-friendly right now, and they are still pursuing collection on that huge TP-Link judgment. So given the market is pricing the entire operation at zero, how much latent high beta upside is still just lurking in that original IP portfolio? I mean, a surprise layer of free cash flow that the market is completely ignoring while it focuses on the industrial cycle.
It's a non-zero lottery ticket that you're basically getting for free. So yeah, keep an eye on that residual IP value. It could be a very unexpected catalyst in 2026.